So now we're going to be moving into fixed income instruments. So those are going to be bonds that pay coupon payments as well as the final delivery of principal at maturity. Now, I want to point out that we'll be focusing primarily on government issues, and we'll cover private issues and corporate bonds a little bit in Chapter 10 and 11, but primarily we'll be looking at government issues. So we've talked a little bit about Singapore government treasury issues. Now let's move over to the U.S. For the U.S., we actually have both U.S. Treasury bonds and notes. The only difference between a bond and a note is the maturity date when the bond is issued. So for example, for a bond, the maturity date is from 10 to 30 years. For a note, the maturity date is up to 10 years. The denomination for U.S. Treasury bonds, in other words, the face value in financial management, the denomination is going to be $1,000. And these bonds pay coupons. So notes and bonds pay coupons, bills don't. Remember, bills, money market instruments. Considered to be very, very, very safe from a default risk perspective. In other words, there is a very high probability that you will be getting back your money if you hold the bond to maturity. And we also want to point out one more debt instrument, and this is a Treasury Inflation Protected Security, or a TIPS issue. So now, TIPS issues are interesting because with a TIPS issue, the principal is adjusted by the inflation rate every year. So what it does is it'll guarantee you a real rate of return. If I just buy a treasury bond, and if inflation is really high, the real value, in other words, what I can actually buy with money when, for example, the principal is returned to me, is less in the future if inflation is high. With the treasury, with a TIPS issue, I'm actually protected against erosion in value because of the effects of inflation, which means that I earn a guaranteed real rate of return. For us, it's also going to be useful for backing out the market expected inflation rate. So what is the market expected inflation rate? Well, if you recall from financial management, the nominal yield for, let's say, a treasury bond is going to equal the real yield for the treasury bond plus expected inflation over the duration of the investment horizon, or until the maturity of the issue. And so we can then use the observed yield on the TIPS issue and the observed yield on the treasury issue. We take the difference between the two, and that's market expected inflation over from now until the maturity of the issue. So let's take a look at some example treasury notes and bonds prices and yields. So this is from July 2011 and is looking at issues that are around November 2015. You can see the blue highlighted row is for the 2015 4.5% coupon bond. And there are two different prices. Now we'll talk about what those two different prices are in a moment. Let's jump all the way over to the yield to maturity. That is 1.4% or 1.41%, and exceptionally low annual return for this bond. So you're not making a lot of money by buying this treasury bill issue. Let's jump over to the bid and ask column. You'll notice that the bid column is $112.93 plus something, where the asked column is $113. I want to point out the difference between the bid and the ask. The bid is what the dealer is going to pay you if you sell them the treasury bond, whereas the ask is what you pay the dealer. So the difference between the bid and the ask is the dealer's profit. And that's going to be like the transaction cost for you.